Hello and welcome to Beyond the Charts. This is a show where we dive into fascinating charts from the world of finance and the economy, and we break down what is exactly going down beneath the surface. Also, if you want to view all the charts and sources that are discussed in this video, do check out our newsletter. You can find the link in the description down below. Look, over the past 1 month or so, major Indian companies have been releasing their quarterly results, and there has been one noticeable pattern in all of this. Many of these companies are now falling short of their earnings estimates. Now the thing is, when multiple companies start to struggle in order to meet expectations, it often signals broader economic issues in the country. So in this week's episode here, let's take a look at what key high-frequency economic indicators are telling us about our economy currently speaking. By the way, you can think of high-frequency indicators as regular health checkups for the economy of sorts. Let's begin by understanding what's happening with auto sales, which have been particularly interesting here. See, the Indian auto industry has been struggling pretty badly with weak consumer demand in recent few months. Things were especially tough between the months of May and September, where sales consistently dipped down. But that said, October did bring in some sort of relief because of the festive season of Navratri, Dussehra and Diwali. Now, two-wheeler sales over here jumped by over 36% year on year, while passenger vehicles such as cars and SUVs saw about a 33% rise. Other segments in the automotive sector like three-wheelers and commercial vehicles, which by the way are trucks, buses and transport vehicles, also showed some healthy demand. But that said, tractor sales remained sluggish throughout this period. Now, while October's festive boost was a welcome news for auto manufacturers in a lot of ways, the big question still remains, will this upward trend continue or will the industry start to face another slowdown in the coming few months once the festive season slows down? This festival bump also shows up in the vehicle registration data, which showed an uptick in the month of October. An interesting trend to look at here is consumer preferences in vehicle purchases. Look, while electric vehicles are still in their very early stages in India, electric two-wheelers have shown some great growth. Despite their sales number coming from a smaller base, so to speak, they haven't quite experienced the same level of slowdown as their traditional petrol equivalents. But if you look at the passenger vehicle market, the story is fairly different. Electric cars and SUVs have not gained the same traction as traditional petrol and diesel vehicles. But that said, CNG models have seen a fairly healthy growth in the recent few months. But that said, the question still remains, what is the reason for the slowdown in auto sales? Look, there are a few factors at play here. The first one is weather. See, weather disruptions have played a major role here. Extreme summer heat, which were followed by heavy monsoon rains and also floods, have very significantly impacted buying patterns in the first half of this year. The second thing is dealer inventory management. Look, many dealers, especially in the passenger vehicle segments, are now struggling with high levels of unsold stockpiles. This creates significant financial burdens because they face increased storage costs and also have their capital tied up in their inventory. Now, to make matters even worse here, manufacturers continue to push new stock onto dealers, which forces them to offer steep discounts in order to move vehicles to the consumers. Now, this aggressive and deep discounting cuts deeply into dealer profits and also creates cash flow challenges for them. The third reason is economic factors. Look, there is a noticeable reduction in government spending, which has led to decreased demand for commercial vehicles now. There has also been a very visible slowdown in construction and infrastructure projects, which has hit the sector very hard. Let's understand this a little better by looking at Tata Motors. The company recently reported a substantial 19.6% drop in domestic sales as compared to last year. They cited reduced infrastructure projects and mining activity as major factors for this. Now, the slowdown in auto sales shows up in the wholesale volumes or purchases by dealers as well. See, passenger vehicles wholesale volumes are down sharply, while two-wheeler wholesale volumes look fairly good based on data from ICICI Bank's research. And the slowdown, by the way, is not just limited to automobiles. We are now seeing signs of a broad-based slowdown in urban spending altogether. But the good news still is that there are signs that rural demand seems to be bouncing back thanks to good monsoons. Now, whether the uptick in rural consumption is a sustained trend still remains to be seen, but whatever we have is probably good news for now. But back to the urban consumption areas, the slowdown that I'm talking about in urban consumption is now also showing up in FMCG results. According to Britannia's recent investor presentation, metropolitan areas, which account for about 30% of FMCG sales, are leading the slowdown, so to speak. They are contributing about 2.5 times more to the decline in sales than the other regions of the country. Now, if you're wondering, this urban slowdown can be traced to two major factors. The first one is housing expenditure, which is important because it consumes about 22% of urban consumer spending. The rise in inflation, especially food inflation, has hit household budgets pretty hard, and this has led to an increase in the cost of living. To add to it here, most urban households have seen a very little increase in their earnings during this particular time period. So this has created a significant squeeze on urban consumers' purchasing power, so to speak. Now, like I mentioned just some time ago, inflation has hit households pretty hard in India, and there are now some worrying inflationary trends in the recent data that shows up. The latest data shows how CPI inflation has spiked to 6.2% in October 2024 and has reached its highest level in the last 14 months. Now, mind you, this is a significant jump from September's 5.5%. What's even more worrying over here is that core inflation, which by the way excludes volatile items like food and fuel, has also hit a 10-month high now. Now, this inflation spike specifically could further worsen consumer spending slowdown that we are seeing in both the auto and the FMCG sectors. And the reason for this is because inflation further erodes purchasing power of households that are already struggling with stagnant incomes and also higher living costs. Now, one of the biggest reasons for this spike in inflation this time around is food inflation, especially in vegetables and fruits. And all hope now rests on whether the good monsoons will continue to help reduce food prices or not. Speaking of monsoons though, we have more or less had a good monsoon this time around. There are some minor concerns though. Rainfall has dipped below the long-term average towards the end of September. But that said, the total accumulated rainfall for the season still remains above long-term average, which is a good sign, so to speak. The worry here though is that key agricultural regions in India like Punjab and Haryana have received lesser than normal rainfall this time around. Now, whether or not this will affect food prices still remains to be seen, but this is not great of a sign for sure. Back to consumer spending, the pullback in this particular area has also reflected in personal loan trends now. There has been a slowdown in personal loans across almost all categories now. The most notable decline here is in consumer durables financing, which for your context is loans for appliances, furniture, electronics, and other household items. This slowdown has two main causes once again. First is that rising inflation has reduced how much money households can spend on non-essential items. In addition to this, the RBI's actions have made borrowing a little more expensive. To give you further context on this, since April 2022, they have raised interest rates from 4% to about 6.5% in order to control inflation. The RBI has kept rates high even as the Federal Reserve of the US and other emerging markets have started lowering their interest rates. Moving on, credit card and other personal loans, which are typically used for expenses like travel, medical needs, education, or other personal requirements, have also seen a growth rate decline very significantly here. Now, this particular slowdown maybe directly ties into RBI's recent interventions. We spoke about how RBI was concerned about the rise in unsecured lending and they took action in November 2023 by increasing risk weights for unsecured loans. As a result of which, banks now faced a 150% risk weight, which is up 25 percentage points, and NBFCs must maintain a 125% risk weight, which is also up 25 points. With banks having to set aside a little more capital than they did before for loans, this leads to higher interest rates for borrowers like you and me at the end of the day. Now that said, despite recent drops in consumer spending, Indians currently remain surprisingly optimistic about the economy overall according to the RBI's Consumer Confidence Survey. The Current Situation Index, which shows how people exactly feel about the current economic condition, rose to 96.6 in September. The Future Sentiment Survey hit about 121.4, which indicates that Indians are very hopeful of where the economy will be next year. So while people are being careful with their spending now due to high inflation and interest rates, they are also fairly optimistic about the future, so to speak. So this suggests that the current spending slowdown might be a little more temporary rather than a sign of deeper economic problems in our country. With that, let's now shift gears a little bit and talk about what core industries of our country are saying about the economy. See, there are 8 key sectors that are the backbone of our economy in a manner of speaking. This is because they provide essential raw materials and infrastructure in order to support other industries in the country. Now, looking at how these sectors are performing, the picture is not particularly bright, to be very honest. The core sector index, which for your context tracks all 8 industries, shows a bit of a worrying trend here. After actually shrinking in the month of August, September only managed a small growth percentage of about 2%. And this, mind you, is the weakest performance that we've seen since October 2022. Now, this sluggish growth in such fundamental sectors raises some questions about the broader economic momentum. When we break down the performance of individual core sectors, we see a broad slowdown as well. Cement, crude oil, fertilizers, petroleum products, and steel have all been showing particular weakness over the last few months or so. The month of September showed only a slight improvement. Only 3 sectors, cement, crude oil, and petroleum, managed to show any meaningful recovery in a manner of speaking. This limited improvement is particularly worrying for us because these core sectors do not quite operate in isolation. They feed into other sectors of the economy, like I mentioned. Now, the fact that most of these fundamental industries remain weak may somewhat suggest a broader economic slowdown underway. You can think about it like taking the economy's temperature in a manner of speaking. When essential sectors are running cold, it could signal reduced activity across the wide economic landscape. Now, the sluggish performance of core sectors can also be seen in broader industrial production numbers. September's industrial production growth came in at just 3.1%. Now, while this is definitely an improvement over August figures, it still shows the slowest growth rate that we have seen since November 2023. As per a Motilal Oswal report, the slight improvement in industry activity came from two main areas, mining and manufacturing. Now, while we're at it, let's quickly take a look at this, starting with manufacturing, which showed some encouraging signs with output rising 3.9% in September. And this, by the way, is a notable jump from August's modest 1.1% growth. But that said, the recovery is not quite uniform here. About half of all manufacturing items still showed slower growth as compared to last year. While this may sound a little concerning in a manner of speaking, it is actually an improvement from the month of August when nearly 4 out of 5 items were growing more slowly than the previous year. The mining sector turned a little positive here with a small 0.2% increase, and this recovered from the August month decline. But that said, the growth here is still below what we saw last year. But that said, perhaps the most concerning out here in all of this is the electricity sector's performance. Over here, output grew just by 0.5% and marked its weakest growth in the last 17 months. Now, this sluggish electricity growth is particularly noteworthy because power consumption usually serves as a great indicator of overall economic activity. But the good news here is that September 2024 brought some encouraging news for all of us in the consumer goods area. Overall production hit its best level in the last 4 months and grew by about 3.9%. But the weird thing here is that sales of these consumer goods has actually been steadily declining instead. Let's now move on and look at energy consumption, which is a fairly key indicator of economic activity in the country. And over here, we are seeing some worrying signs, so it is important to understand. See, there's been a slowdown in diesel and electricity usage, like I mentioned, which are two forms of energy that power a lot of India's economic activity today. This is fairly significant because diesel and electricity consumption tell us a fair bit about what is happening across the economy. Diesel, like I'm sure you already know, powers pretty much everything, from trucks that transport our goods to generators which keep our factories running. On the other hand, electricity is fundamental to nearly every sector of the economy. Now, the thing is, the fall in diesel consumption could actually be due to good monsoons. I'll quickly explain how. See, when monsoons are good, farmers don't quite have to use diesel generators as much, and this means diesel consumption could be fairly less as compared to normal. There could also, of course, be a seasonality effect to this because rainfalls may affect transportation and hence fuel consumption as a result of it. Now, moving on, the month of October brought some pretty encouraging news from the manufacturing sector. After 3 consecutive months of slowing growth, India's manufacturing PMI, which as reported by HSBC, showed a rebound. But before diving into the details, let's very quickly understand what PMI actually means for the sake of those people who do not know. Now, the full form of PMI is Purchasing Managers Index, and this is a key measure of how well our manufacturing and services sectors are performing, so to speak. It's not just any survey, mind you. It captures insights from senior purchasing managers at 400 manufacturing companies, looking at 5 crucial areas: new orders, production, hiring, supplier delivery times, and inventory levels as well. Now, this index uses a simple scale from 0 to 100, where any reading above 50 is usually a sign of growth from the previous month, and below 50 is an indicator of contraction. Now, this is particularly valuable for us because it reflects how key decision makers at major companies in the country view the economy's direction. Now, if that's fairly clear, let's move back to the latest PMI report, which highlights a few points for this revival. First, domestic and international orders increased, which boosted production volumes. Second, there was also employment growth, and this resulted in reduced backlogs for the first time in over a year or so. Third, business sentiment improved with optimism for ongoing demand and new product releases. But that said, the report also highlighted some concerns which we should be aware of. First, input and output prices increased due to persistent inflation in materials, labor, and transportation costs. Now, these rising expenses could put a bit of pressure on profit margins despite robust demand. Let's now turn our attention a little bit and talk about GST collections. Look, since GST applies to almost every good or service that we consume in our day-to-day lives today, their collection numbers give us a great insight into the overall economic activity in the country. Now, strong collections, as you might imagine, typically means that consumers are spending, businesses are selling, and the economy as an overall is doing well. When collections dip, it might signal that people are tightening their belts or business activity is going down. October's GST numbers are a great news for us. GST collections reached about 1.87 lakh crore rupees, and this is a 9% increase compared to the same month last year. Now, this shows that despite some challenges in specific sectors, as we discussed earlier, there is still significant economic activity that is happening across the country. One other important indicator that hit a high in October 2024 was e-way bill collections. Collections here reached about 11.7 crores, which shows a fairly impressive growth, about nearly 19%. But to understand why this exactly matters, let's first break down what e-way bills exactly are. Now, these electronic documents are required whenever goods are transported within or between different states in India. Essentially, they track the movement of goods across the country, which makes them an excellent indicator of transport as well as trade activity in our country. Both GST and e-way bill collections this time around showed strong performance in the month of October, and partly this is thanks to the festive season boost. GST collections have maintained steady growth rates of about 8 to 10%, while e-way bills on the other hand have been growing even stronger at about 14 to 15% over the past few months. Now, this growth shows that despite some problems in some sectors, overall business activity still remains strong. High e-way bill numbers means that goods are moving actively across the country, which shows a healthy trade relation. Now, moving forward, let's look at how ports and railway transportation are performing in the country. Now, these transportation networks tell us a lot about our economic health because they handle everything from raw materials like coal and oil to finished products in shipping containers as well. Now, when these networks are busy, it usually means that businesses are producing more, trade is active, and the economy as a whole is moving forward. But October's numbers from our major ports raise some concerns, so to speak. Cargo volumes have dropped by 3.4% compared to the same period last year. This dip is standing out this time around because it reverses the trend that we saw in the last 4 months when the growth was in the range of 6% or so. By the way, the latest railway freight data is not encouraging either. With just 0.2% growth in August, the most recent data that we have, rail freight movement has essentially flatlined. This sluggish rail freight growth, along with decline in port cargo volumes that we just discussed, paints a picture of a fairly softening demand across multiple industries in our country. Since railways typically serve as a backbone of our domestic goods movement, such weak growth here suggests that industrial activity and internal trade might be losing steam in a manner of speaking. But anyway, moving on, let's look at what is happening in the rural part of India through the lens of MGNREGA, which is the government's Rural Employment Guarantee Program. Now, you can think of MGNREGA as a safety net for rural workers. When people can't find regular work or their farm income is not enough, they turn to this program for guaranteed employment. So counterintuitively, lower demand for MGNREGA work often is a good sign. Now, the latest data here brings some encouraging news about rural economic health. The month of October saw about 1.9 crore people seeking work under MGNREGA, which is a 9.2% drop from last year, and this has been consistently falling for the last 12 months or so. Now, this decline in MGNREGA applications suggests that rural India might be in a better economic shape thanks to good monsoons this time around. This means that people in rural areas are finding better employment opportunities elsewhere, or they are earning enough from their regular work that they do not need to rely on government guaranteed employment programs. But that said, while declining MGNREGA demand suggests a better job availability in rural areas, there is still a concerning trend in rural wages if you think about it. While workers are earning more in absolute terms, high inflation, particularly in essential items like food and fuel, is eating away their actual purchasing power. In many cases, rural workers are finding themselves not really better off, and in some cases even worse off than before. Now, there are a few reasons for this. Harsh Damodran, the national editor on rural affairs and agriculture at the Indian Express, explained this in a very recent article. By the way, you can check out the link in the description below. I'll talk about 3 things from his article. First, due to increased labor force participation, more rural women are working now, which is increasing the labor supply and putting pressure on wages. Second, many of the new workers are now finding jobs in agriculture, which usually pays less wages. Third, the economy is growing in areas that use more machines than people today, and this is reducing the demand for labor and is also limiting wage growth. So if you look beneath the surface, while rural Indians might be finding work a little more easily than they were before, the quality and compensation of these particular jobs is not necessarily improving their standard of living, especially in the face of persistent inflation. So that said, India's economic landscape currently is a bit of a mixed bag. On one hand, there are clear challenges, which is slowdown in core sectors and industrial production. But on the other hand, the economy is showing resilience in some important areas. Strong festive season spending and healthy GST collections indicate that consumer confidence is not completely shaken till now. But there are some pressing issues that do need our attention. The recent spike in inflation to a 14-month high is a fairly worrying trend because it puts pressure on both consumers and businesses. It is also likely to keep the RBI from cutting rates anytime soon, because they will want inflation firmly below 4% before they will even think of making any moves. So looking ahead, there will be a few key indicators that shed light on where the economy might be headed. Auto sales, rural job market, inflation, etc. will all be important things to look at. Okay, now that said, let's move on to the second section of this episode and talk about how overvalued are Indian markets. See, in the previous episode, I discussed the fall in Indian stock markets and the possible reasons why the markets are falling today. But in today's episode, I wanted to look at PE or price to earnings ratio of Indian indices in a little more detail. But first, for the sake of those people who do not know, let's quickly understand what PE ratio exactly is. Now, you can think of them as price tags for the stock market. Just like we compare prices while shopping, PE ratios pretty much tell us how much we are paying for companies' earnings. For indices like Nifty 50 or Sensex, it is calculating by dividing the total market value of all companies by their combined earnings. Now, a high PE ratio here means that investors are paying more for every rupee of earning that the company has, which is usually because they expect a strong future growth. A low PE, on the other hand, suggests that stocks are cheaper. It could be either due to pessimism about growth or an overlooked value. Now, with that out of the way, let's look at what current PE ratio is telling us today. See, as the markets have seen a significant correction recently from their peak levels of October, the PE ratio for all the major indices has seen a meaningful correction. The Nifty 50's PE has dropped from over 24 to around 21.7. Now, this correction is not limited to large cap. Mid cap, small caps, and micro cap indices have all seen similar PE ratios decline from their previous peak levels. But let's look at another major valuable market indicator over here, which is the cyclically adjusted price to earnings ratio, or the CAPE. Now, while regular PE ratios give us short-term insights, CAPE offers a bit of a longer-term view by adjusting for economic cycles. Now, this helps us understand whether the market is overvalued or undervalued. Now, currently speaking, the CAPE ratios for both Sensex and Nifty 500 have reached levels that have not been seen since the 2008 global financial crisis. Like the PE ratios we discussed earlier, CAPE has also declined recently as markets have adjusted to widespread earnings misses across different companies. Now, this data comes from a site maintained by IIM professors Joshi Jacob and Ranjan Raju. Now, this is something that I had also talked about in the previous week's episode of Beyond the Charts and also on Daily Brief. So if you are interested, you can check out the links from the description below. There's one very important thing for all of us to remember about the valuation ratios here. Markets do not always follow logical patterns. They can stay overpriced or underpriced way longer than you think that is possible. As a famous economist once said, markets can remain irrational longer than you can remain solvent. So while PE and CAPE ratios are very helpful indicators, do not maybe rely on them all alone to decide whether to buy or sell. So while PE and CAPE ratios are fairly helpful indicators, don't maybe only rely on them to decide whether you want to buy or to sell. You can maybe think of them as one or two of the tools in your larger investment toolbox. And the reason why I say this is because what these indicators can help us is by getting a sense of whether stocks might be expensive or cheap. But if you want to look at other factors before making any big investment moves, it is important to look at other aspects as well. Now, talking about market corrections, the Nifty 50 index crossed below its 200 daily moving average level for the first time since April 2023, technically entering bearish territory. For your context, when the market trades above its 200-day moving average, investors typically see it as a healthy upward trending market. But when it drops below this level, just like it did right now, it is usually seen as a warning sign that things might be turning south. But the good news here is that the last time this happened, the market did not stay down for too long. It bounced back just within the next 2 months. But of course, like everyone always says, past performance does not guarantee future returns. Our team then also decided to dig a little deeper into what typically happens after the Nifty drops below its 200-day moving average. Now, looking at the past data here is what we found. Since 1996, Nifty has crossed below 200 DMA on 2,144 occasions, or about 30% of the time. So mind you, this is not an uncommon event at all. Now, even out of these 2,144 instances, Nifty has given positive returns from then on 60% of the times over 1 month period. Now, this number is around 63% and 70% over 6 and 12 month periods. On an average though, the market gained a modest 1.5% over a 1 month period. In the worst case scenario, investors saw a 39% drop, while the best case scenario brought a 35% gain. Now, if you move on to the 6-month picture over here, things get a little more interesting. The average return climbed to 8.4%, which shows a better recovery over time. There was a 50% loss in the worst case scenario and an 87.7% gain in the best case scenario. The 12-month view tells us an even more compelling story. On an average, investors who decided to hold on saw a healthy 19.4% return. The maximum loss over here was about 43.7% and the maximum returns here were about 104%. So all of these numbers suggest that while we may see some volatility in the short term, historically speaking, the market has shown strong recovery potential over the long periods of time after these drops. That's all for today. I hope you found value in this episode. This is your host Anurag Bansal signing off. I'll see you in the next one. Take care and goodbye.